Welcome to May 2025 Tax Roundup. This month, the ATO is reminding trustees and practitioners of key issues to consider when looking at making trust resolutions or decisions before the end of the financial year. The ATO has also stepped up its focus on succession planning and the tax risks that need to be considered. But first, we are going to take a look at the recent case dealing with a property subdivision project, which captured the ATO's attention. Mike, can you fill us in on what happened in this case?
Yeah, thanks. We've got an interesting case this month, which is the Morton case. This is a federal court decision which looked at a taxpayer who had held some farming land from pre-CGT, so a kind of a long ownership period for this property, been used in a farming business for many, many years. But due to basically rezoning of land on the outskirts of Melbourne, it became apparent there was an opportunity to subdivide this land. So basically what the taxpayer did in this case was entered into an agreement with a developer and basically handed over pretty much all responsibility to the developer in order to subdivide and sell the subdivided lots. The property that was being subdivided and sold, this particular property that we were dealing with in this case, was adjoining another property, a larger property, and it ended up being a very large subdivision project. Over 1,600 lots were basically subdivided and sold off. So we're talking about a pretty large-scale subdivision project. This taxpayer, having farmed the land for many years, ended up arguing, well, I suppose took the position anyway when they lodged their tax return, that all they were doing was realising a capital asset in the most advantageous manner, and so basically dealt with the sales on capital account, being pre-CGT land, presumably not a whole lot of tax to pay. Well, the ATO had its attention drawn to this subdivision and sale of land, and the ATO took the opposite view. The ATO took the view that either the taxpayer was carrying on a business of basically subdividing and developing and selling land, or if it wasn't a business activity, it was still an isolated profit-making undertaking that should be taxed on revenue account. And of course, the key thing here being the fact that it was bought pre-CGT wouldn't prevent tax being payable if we're dealing with a transaction taxed on revenue account. That pre-CGT exemption is only relevant for capital gains for assets held on capital account. Well, the taxpayer basically challenged the ATO's view. The taxpayer took this to the federal court, and the short answer here is that the federal court found for the taxpayer. The federal court found that this was not a business of property development, and this was not a profit-making undertaking either. Now, the federal court kind of pointed at a number of factors that were relevant in this decision. For example, it was clear that this land was never purchased in order to subdivide and sell at a profit. This was a block of land that had been held for decades and had been used in farming activities for many years. Even after a development agreement was reached with a developer, the formal agreement had been entered into, the taxpayer continued to use the land in a farming business. The court found that what led to this land being basically sold off was partly the rezoning. The fact that this land was being rezoned as residential would impact on the viability of its status as a farming property. There would be kind of new neighbours coming in, there'd be kind of more traffic, all that sort of stuff. And so the federal court found that there was an external factor that basically led this taxpayer to the decision that it was the right time to subdivide and sell. Importantly, the federal court picked up on the fact that basically the taxpayer handed over kind of everything to the developer. So the taxpayer really wasn't heavily involved personally in the subdivision process. The developer was given kind of all the responsibility to go ahead, deal with development applications, importantly, deal with finance. The taxpayer wasn't responsible for obtaining finance. This was on the developer. And it was really up to the developer to sort out the whole project and market and sell the lots as well. So there's very little personal involvement from the taxpayer when it came to actually completing the subdivision project. One of the other things that the federal court picked up on was, while this was a large-scale project, and particularly when you looked at the neighbouring blocks that were also subdivided and sold as part of the same project, the federal court said that the scale of the project isn't determinative of whether this is a business or a profit-making undertaking or not. The size of the land determined the scale of the project. This just happened to be a really large block of land, neighbouring another large block of land. So by necessity, this was a large-scale project. It wasn't kind of the taxpayers kind of the decision to go, they didn't go out and buy more land in order to increase the size and scale of the project. It was just the size of the land itself that necessitated certain work being performed. And one of the other things, interestingly, that the federal court kind of picked up on was the fact that while there was some work performed, this was all work that was required by the council in order for the subdivision to be approved. So putting in footpaths and utilities, putting in roads, undertaking some earthworks, these are things required by the council. These were not things that were done voluntarily by the taxpayer to try and maximise the profits from the project. So when you put all of those factors together, the federal court was satisfied that this was not a business activity. This was not a profit-making undertaking. This was a taxpayer sitting on a large capital asset, merely obtaining a good sale price for that asset. Now, interestingly, the federal court said that this taxpayer could have actually done more to increase the profit even further, but for their own reasons, they decided actually to put a kind of a limit on the extent to which this property would be dealt with and some of the steps that they took. That also seemed to work in their favour. Now, one of the things the federal court mentioned was, and look, this is simplistic and the federal court acknowledges this, but the fact that the taxpayer had effectively delegated the project to a developer and the developer was carrying on a business of developing properties, the federal court said that that doesn't necessarily mean that the property owner, the landowner, is therefore carrying on a property development business. The federal court used the example of someone who owns a property and they need some plumbing work done. They engage a plumber to come and do the plumbing work. The plumber carries on a plumbing business. It doesn't mean that the landowner now carries on a plumbing business. While simplistic, federal court said the fact that there is a developer involved and that developer might run a development business doesn't mean that the landowner is necessarily carrying on a business in their own right. Now, the twist at the end here is that while the taxpayer was successful in this case, arguing that this was a capital transaction, the ATO has appealed the decision. So we really do need to wait and see where this ends up at the end of the day. But a really good reminder of how we might approach things like this. This can be a really complex area. We're often dealing with pretty big dollars, so there's often a fair bit of tax at stake one way or the other, and you'll find that the ATO is pretty interested in looking at situations like this, particularly where a taxpayer has argued that this is a capital transaction. So while the taxpayer was successful in this case, we need to take care with these sorts of projects. We need to look at all the relevant facts and circumstances. It's a story that we hear all the time. It really depends on the facts of the case. While we don't read too much into this decision when we're looking at, say, our client's own circumstances, there is still some really helpful guidance that comes out of this case in terms of some of the factors that we'd be looking at and some of the things that might help support a capital account argument, which is where a lot of our clients are hoping to end up. So that's the Morton case. There's still more to come at some stage, and we'll give you an update when that happens.
Thanks, Mike. What are some of the other things that practitioners need to consider when clients are involved in property subdivision projects?
When clients are involved in subdivision projects, there are a whole lot of issues that we need to consider. So certainly we need to start with the capital revenue distinction. That's the most important part, at least initially, because that will determine to a large extent how much tax our client is going to pay, kind of regardless of what else they've done from that point onwards. So that capital revenue distinction, which is what the Morton case was really focusing on, is absolutely critical whenever clients are involved in property transactions. One of the things that the Morton case looked at, and it wasn't kind of all that important, I guess, at the end of the day, because the federal court found in favour of the taxpayer, but the federal court was asked to consider, well, if this was a business of property development, or if this was a profit-making undertaking, at what point was the land actually contributed to that business or that project? And the federal court basically said, look, there was a period of time where the taxpayer entered into that agreement with the developer, that third party who was going to develop the property. That was the point in time that it would have switched to being held on revenue account if we ended up on revenue account in the first place. Now, we didn't in this case, but the federal court said it was when they entered into that formal agreement with the developer, that would have been the time that the change occurred. Now, that can be relevant because when we do go from holding something on capital account and then flip it onto revenue account, that can have some flow-on tax implications. For example, it can impact on how we calculate the profit that ends up being taxed on revenue account, but it can also impact on a few other things as well. And one of those things is the GST position. For example, if you've got a client who is involved in a property project and it ends up being taxed on revenue account, it is highly likely that that will trigger some GST implications. On the other hand, when someone has a block of land and they're subdividing it and it ends up being the mere realisation of a capital asset, you might find in some cases, in many cases, if they're not already registered for GST, you'll often find that that project doesn't end up falling within the scope of the GST rules. And it's just the way the GST registration rules happen to play out. So that revenue capital distinction, really important in terms of kind of the income tax, the CGT position, but can also have a pretty big flow-on impact from a GST point of view as well. Now, even if we have a client who is holding land on capital account and that project, for example, a subdivision project, is still treated as being on capital account, there are still some important tax issues that we're going to need to navigate in many cases. One of those is cost base. We need to allocate the cost base of the original property across those subdivided lots, and that needs to be done on a reasonable basis. And we need to approach each element of cost base a little bit differently. It will depend on our client's circumstances. Don't forget, there will also be some costs incurred in undertaking the subdivision project. Those will need to be spread across the subdivided lots as well. If you're dealing with a property that contains a dwelling that has been used as the client's main residence, you'll need to consider the impact that the subdivision and sale of some of the land might have from a main residence perspective. For example, if you've got a client who has their house on a block of land, they subdivide that land into smaller lots and then sell a vacant lot on its own, that probably won't qualify for the main residence exemption, even if that land has been used primarily for private and domestic purposes in association with a dwelling. In order for land to fall within the scope of the main residence exemption provisions, it will normally need to be sold together with the dwelling that has been used as the client's main residence, normally as part of the same transaction to the same purchaser. So a subdivision project can potentially cause part of a property to then fall outside the scope of the main residence provisions. This can also have a similar impact from a small business CGT perspective. We've certainly seen cases where clients have a property. The property as a whole would be classified as an active asset for small business CGT concession purposes. However, there might be individual parts of that property that aren't actively used in the business. If we were to subdivide those parts and sell them separately, we might find that that separate sale doesn't qualify for the small business CGT concessions because effectively we now have a separate asset. We now need to apply the active asset test to that asset in its own right. The fact that it used to be connected with a larger property that was used in a business isn't necessarily enough to gain access to the small business CGT concessions. So when clients are subdividing property, even if we're confident that the project will be taxed on capital account, there are still a range of tax issues we will need to carefully consider. If the client is already registered for GST, then we need to very carefully consider their GST position and start thinking through maybe concessions within the rules that might be available. Farmland concessions, the margin scheme, maybe going concern rules, probably less relevant for subdivided land, but all those things need to be considered. The timing issues, cost-based issues, main residence, small business CGTs, so many things that we're still going to need to consider even if we're confident we're dealing with a capital account transaction. So property subdivisions, we come across them, often complex area. Certainly the Morton case is maybe helpful, but let's wait and see. The full federal court might decide to go the other way. But look, certainly an area that we need to walk our clients through very carefully and an area where upfront planning and analysis can be incredibly valuable. We've certainly seen cases where clients spent a lot of time, energy, effort, and money subdividing a property to maximise a sale price, but actually ended up worse than what they would have been had they simply sold the property as is without all that time, energy, and effort. So upfront planning, incredibly important, but it does rely on your client letting you know what their plans are. So checking in with them regularly just to see whether they've got any plans can really help with that process.
And the ATO continues to focus on trust and trust distributions and has issued a warning on specific issues to consider in connection with year-end trust distributions. What are some of the main issues and things to note as 30th June approaches?
Thanks, Amy. So as a starting point, before making distributions, it's important for trustees to understand how income is defined under their particular trust deed. So this means looking closely at the trust deed clauses that define trust income. So while practitioners often refer to accounting income or accounting profit, this won't always directly be relevant when you're looking at the tax position for the trust or its beneficiaries. Instead, there can be a variety of ways that income is defined under the actual deed. So for example, trust income might be determined at the discretion of the trustee, or as defined as ordinary income under trust law, or as net income under Section 95, among others. Next, the trustee needs to identify the trust's beneficiaries. So again, this requires reviewing the beneficiary clauses in the trust deed. So for family trusts, just because someone is a close relative or an entity appears to be controlled by a family member, that doesn't necessarily mean that they're a beneficiary under the trust deed. It's also important to check whether there are family trust elections or interposed entity elections in place, as these might limit who the trust can actually distribute to without triggering family trust distribution tax. For family groups, this also includes checking the family trust elections and interposed entity elections for related group entities as well. And the family trust election rules are actually far more restrictive than many practitioners realise. And entities that may seem to fall within the economic group might not actually be part of the family group under these rules. Trustees also need to ensure that valid distributions are made prior to year end. Again, it's essential to check the requirements under the deed. So for example, some deeds may require trustee resolutions to be in writing by a particular date to be considered valid resolutions. Generally in practice, even if the minutes of a meeting aren't formalised or signed until after year end, it's important that someone has kept notes or draft minutes that reflect any decisions made prior to 30th of June. And where the trustee is a company, you might also need to consider any specific requirements that apply under the company's constitution or the Corps Act and ensure that these are also met. If the trustee doesn't make any beneficiaries presently entitled to the income of the trust estate by 30th of June or year end, the general outcome is that the trustee will be assessed on all of the net income of the trust under Section 99A and taxed at the highest marginal rate. In some cases, certain trusts might have default beneficiaries or distribution clauses, which can be activated where the trustee doesn't appoint some or all of the income. However, this really depends on the trust.
Thanks, Anne. The ATO is also focusing on tax issues that can arise in relation to succession planning, or the lack of it. What are some of the things to keep in mind?
Thanks, Amy. So the ATO is seeing increased succession activity, things like group restructures, asset disposals, and transfers of funds, as business owners get older and begin to retire. As a result, there's been a rise in private groups facing significant and sometimes unexpected tax outcomes. In simple cases, succession planning might just involve someone passing away with their assets left to beneficiaries under a will. While Australia doesn't have inheritance or death taxes, there are special rules around the cost base of inherited assets, and capital gains tax can still apply when those assets are eventually sold by the estate or beneficiaries. But more broadly, in succession planning, any change in the ownership of an asset usually results in a taxable event. If an asset is transferred for no consideration or to a related entity, the market value substitution rule can apply. So it's crucial to get the valuations right. So for example, in the 2024 AAT case Maloney, the valuation of the shares was central to whether the taxpayer could satisfy the $6 million maximum net asset value test and ultimately access the small business CGT concessions. Just because an asset was originally acquired pre-CGT, that doesn't necessarily mean that there won't be tax consequences when it's transferred or sold later on. Under Division 149, a pre-CGT asset loses that status if the majority underlying interests in the asset are no longer held by the same ultimate owners who held them just before 20th of September 1985. There's also the CGT event K6, which can apply when pre-CGT shares or units are sold and the underlying company or trust also holds post-CGT assets that make up at least 75% of the net value. Again, this is something that can be easily overlooked if not properly planned and result in significant unintended CGT being payable. Clients should also be aware of potential Division 7A risks, especially where there are loans or payments between related entities within the group. So Div 7A issues can also often arise when there are wind-ups and there are loans being forgiven or waived. The ATO is also paying close attention to trusts in the context of succession-related restructures. So for example, if there are amendments to the trust deed, such as to the trustee or appointer, adding or removing beneficiaries, or even adjusting the vesting date, those changes, if they are not in accordance with the powers under the deed, could amount to a resettlement of the trust. Family trust elections and interposed entity elections also need to be considered. So any distributions made outside of the family group can potentially trigger family trust distribution tax. And this area can get especially complex when certain test individuals in the group pass away or the group structure continues to evolve to later generations.
Thanks, Anne. Now, that's it for this month's Tax Roundup. As we get closer to the end of the financial year, the ATO is turning its focus to trust resolutions, reminding trustees to stay on top of their obligations and be mindful of the tax risks that can easily slip through the cracks. Keep an eye out for our year-end materials, which will be released shortly to help you navigate this busy period with confidence. And if you're not already a Knowledge Shop member, now is a great time to reach out and find out how we can support you. Our members gain access to expert guidance through our hugely popular help desk, practical training to stay sharp and compliant, and a comprehensive library of tools, templates, and resources designed to make your job easier and more efficient. Get in touch with us today. We'd love to welcome you to the Knowledge Shop community. Thank you for watching and see you next month.